Okay. Chapter 10. So here's chapter 10. We're going to be working on sales on account when you make a sale to a customer on account. It'll be very similar to when we purchased merchandise on account. When we did that in chapter 9, we journalized it in the new purchases journal. So now when we make a sale on account, we will put the journal entry into the sales journal. And so in chapter 9, when we made purchases on account, we had the purchase journal, and then we had the accounts payable ledger, the subsidiary ledger. Chapter 10, with the sales journal, we will have the accounts receivable ledger. So that's what we're going to be talking about today here. So this should look hopefully familiar. The subsidiary ledger, this is very similar to what we had gone through in chapter 9. Accounts receivable here is like a file cabinet, and inside that is all our customers. Each one of these customers has purchased something on account, so they have updated balances. The way to do that is when we go in chapter 10.2 is post and update their balances. But this is a subsidiary ledger. These are not going to be in the general ledger where you have, like we've always had with cash, supplies, prepaid insurance, all the way down through all the expenses. This will be its separate ledger like the accounts payable. We will have the accounts receivable ledger for customers when we make sales on account to them, when they purchase merchandise from us. So it'll be called a sale on account. Each one of these balances, when you add them up, this 10,498 number should equal the controlling account, accounts receivable. Last chapter, this was the controlling account was accounts payable. Now it's the accounts receivable. So accounts receivable is the subsidiary ledger. The amount business receives from sale on an item of merchandise is called a selling price. So when we sell something, we will make a sales credit journal entry. But that does not include sales tax and things like that. But the selling price is the amount the business receives when we sell an item. We buy it from our vendors at a certain price, and then we have to do what's called a markup. The amount the business adds to the cost of merchandise to establish what we just talked about with the selling price. So for example, you buy a shoe for $25 from a vendor and you sell it for $65. The markup is the difference. The cost of the merchandise is what we sold it for, or what we bought it for, the cost of what we purchased the item for. Then we have to mark it up to make money, right? And that is the selling price, right? The idea behind business is obviously we want to make some money. We want to continue to have customers. We want to continue to have, be able to pay our bills, pay our employees. So we have to have this markup in cost so that we can pay for everything. So the selling price is what we're going to sell the item for. The markup is the amount we add to the cost that we originally purchased it for to get the selling price. Sales of merchandise will be two different ways. We'll sell merchandise for cash. That'll be in the cash receipts journal. Or we'll make a sale of merchandise on account, which will be in the sales journal. Okay. The realization of revenue accounting concept, regardless when payment is received, revenue should be recorded when a sale is made, not when cash is received, but when the sale goes through, that's when we're going to record it. We usually used to use general ledger accounts, to journalize everything. But now, as we're a corporation, we're getting bigger, we're making more transactions, we have more customers. It's not a feasible thing. And so we need to have this subsidiary ledger so that we can keep our customers' balances in one spot. So the accounts receivable subsidiary ledger that we just talked about contains all the accounts for the charged customers. The total amount owed by these customers will equal the controlling account accounts receivable. So we've already mentioned that before. We'll have this new ledger with the accounts receivable with all our customers that we make sales on account to, and all those numbers added up should equal accounts receivable. Reason we do this is to ensure that collection from these customers is possible. Okay, Accounts receivable, just a reminder, as a general reminder, is increased debit. That's nothing new. That's just something we, just going over. When we do accounts receivable, just like before, the subsidiary will be, the first number is where the digit arrives in the chart of accounts, assets for accounts receivable. The second two is unique to the customer, where it fits in the subsidiary ledger. We usually are doing them alphabetically every 10, like we've done. Again, the controlling accounts receivable is going to be an asset. It would be one. Start with a 1. All right, subsidiary ledger form. So this is something that we should recognize. This is the general ledger. An accounts receivable general ledger. We have the date. You got the post reference where you put the page number, the debit or credit so that the account has, and then the balance with the both debit and credit. That's a general ledger account. You can put any account on there, and this will never change. This blue one is the example of the subsidiary ledger form. And for us, this is an accounts receivable subsidiary ledger form. You can see the parts that are circled. There is no change. They're the same for both. The only difference is the general ledger accounts have debit and credit, while our subsidiary ledger will have only an accounts receivable will only have a debit balance. The reason for that is accounts receivables normal balance is a debit, so we will never have a credit balance for a customer. They will either owe us money or they'll pay it off to zero. They will not give us more money. So that's why the debit balance is here. Okay, and this is just explaining that accounts receivable has a normal debit balance. Therefore, all the subsidiary ledgers and accounts receivable will only have a debit balance, and they have the steps there. This will be what we're going to have to do for our problem. You'll have to put the customer name here, the customer number, the word balance, the check mark, the date, and then the balance here. These two will be left blank when we open, and every fiscal period when we start a new month, these will be left blank. We'll do that and work together. All right, so now we're going to have sales tax. 3 Green is our customer, is our company name, and they're going to be charging sales tax. They got to keep track of that because there's laws involved in which you have to pay that sales tax to the government. All right, what is sales tax? It's just a tax that is applied usually in a form of a percentage on the sale of all the goods and services that we sell. We're a merchandise selling group, so whatever we sell, then we will take a sales tax. Our examples are always in the book 6%, and then in our problems, you'll have to read the directions. Often it'll be 6, but it could be 5, could be 7, could be 8. Just depends on what the example says. Every business collects sales tax, needs to keep accurate amounts of what our total sales are, which we will credit to sales, and then what our total sales tax collected is, because we need to pay that to the government later. And so we will keep track of totals for all our sales, separate from all our sales tax that we collect. Sales tax payable is a new account. The amount of sales tax collected is considered a liability until we pay the government. That seems weird that we're taking in cash and we say it's a liability, but it's not ours. It's a bill that we will later have to pay to the government. That sales tax is not the company's. This isn't 3 Greens. That is the government. So when you'll see that on a test question, sales tax is an asset. False. Sales tax is a liability until you pay the government. True. All right. So the sales tax amount is recorded in a separate liability, just like accounts payable. Sales tax payable is a new account with a credit balance. The main thing, one of the things we want to talk about is sales to nonprofit organizations. So what we mean by that is churches, schools, if you have like a charity organization, government agency, which is a college, maybe state college, whatever the case may be, sometimes they will be exempt from paying taxes, meaning they don't have to pay it. Okay. See if this is, oh, yeah, I'm losing my pictures. Sales journal. This is what the sales journal will look like. It has the 3 special amount columns. They're special amount columns because they have accounts receivable, sales, and sales tax payable. All 3 titles of the columns are general ledger accounts. So sales journal is a special journal record only charge sales on account. We will not put cash sales in here, just when we make a sale on account. All right, so all those charge accounts will be there. This just says those are the three that have it. Sales invoice. This should look familiar. When you make a sales invoice, it is very similar to when somebody purchases. A sales invoice for the person that's selling it is the same as a purchase invoice for somebody who's getting it, basically. Because you have the quantity, you have the item, the unit price, the totals, you have the company names, who's buying it. Sales invoices will be numerical, in numerical order. It'll have customer IDs and the terms, all right? So an invoice is a form that describes goods or services sold, the quantity, price, and the items. That's what we're talking about. It can either be a purchase invoice or a sales, depending on what side of the transaction you are in. Sales invoices are also known as sales slips or sales tickets. And this is just as another kind of reminder of what I was just talking about. The seller considers an invoice to be a sale on account. If it's a sales invoice, sales invoice is considered to be the purchase invoice for the customer. How many copies will there be? There'll be 2 copies, one for the customer, one for the company. The company will use it as a source document to file and to journalize. The customer will use it as their kind of receipt. This is just a reminder that 3 Green, our book example, will often be using 6% sales tax. A sale on account, then, now we get to the point where we have a transaction. November 4th says sold merchandise on account to Wells Apartments plus sales tax for our total. They give you the numbers there. They give you the sales invoice as its source document. All right. So whenever we make a sale, the sale itself is going to be the sales credit. We will then have to figure tax, so they'll give it to us. In this example, they give it to you. Other examples, they'll just give you this number, and you will have to multiply it by 0.06 or by whatever the sales tax percentage is. And then you will place the sales tax payable here. Both sales and sales tax payable are increased with credits. So that's why you see the credit. And both these 2 credits, when added up, is what we will charge our customer, Wells Apartments, for this example. So the debit has to equal the 2 credits, kind of like what we're used to. Okay. This tells you that not every customer can be a charge account. We got to make sure that they're approved to purchase it on account. This just shows you the T accounts. This paragraph here is telling you what the T accounts is showing you. The T accounts showing you it's an increase to accounts receivable when we make a sale on account. It's an increase to sales when we make a sale on account, which means it's a credit to sales. And it's an increase in sales tax payable. Again, regardless of when payment is received, we are going to make the sale, and we're going to record the sale because it's a realization of revenue. All right. When we put the account in here, we only need to use one line. We don't need to credit sales and sales tax payable and write them all down. We're only going to use one line. The name we will put in here is the customer, and so that's what they're talking about here. The name of the customer is the one written down in the accounts receivable debit. This part just shows you how they figured out all that. This is the sale amount. You multiply it by 6%, 0.06 to get the sales tax. You take the tax, add it to the sale, and you get your total. This would be the account receivable debit. Some states, again, as a reminder, exempt schools, nonprofit organizations, churches, religions, whatnot, from paying sales tax. If that's the case, you just would put the sale and the sale amount there. All right, and we'll show you that when we get to the accounts payable. That's it.